Okay, you can go ahead.
All righty. Well, hi, everybody. Welcome back one last time. And thank you for making it through the whole week and for those that have attended the previous sessions. So, for anyone just joining this final session in particular, my name is James Knape. I'm a CPA and lead US partnerships at SUMM. For context, we're a crypto tax and accounting firm, our platform used in over 180 countries and by a few thousand accounting firms. So, crypto tax is what I'm familiar with. I'm a former specialist in crypto tax, now leading growth at SUMM. So this section is more the capstone. On Wednesday, we built the foundation on how IRS sees crypto. Thursday, we went really deep into the 1099 DA, which is the new broker form. And today, we're going to put a bit of everything together into one thing, what I like to refer as the workflow. So the actual repeatable start to finish process that takes a client's messy pile of wallets and exchanges and will actually turn it into clean, defensible numbers on a finished tax return. So if the first 2 days were the theory, today is more so the practice, the how to on how you could run your Monday mornings in crypto. So what we're going to cover for the next 50 minutes is you're going to have a 5-stage pipeline you could run on any crypto client who walks through the door, no matter their complexity. You're going to know how to scope the engagement so it doesn't cause any major issues, how to gather all the data, and then how to classify what you find. Finally, after that, we're going to learn how to reconcile it into numbers you could actually defend and exactly where that figure lands on the tax return. So, in summary, scope, gather, classify, reconcile, report. That's the entire game. And by the end of the hour, we're going to be familiar with how to do it. So, 30 seconds of orientation because today ties the bow on everything. Think of the week as 3 layers where each one builds off the last. So, day one was the foundation. We learned crypto is property, disposing of it is the taxable event, and then the nuanced difference between the capital gain treatment and the ordinary income. Day two was a dive on the 1099 DA, which is the new broker form. So we went box by box, learned how to reconcile it against your client record. And now today is the actual workflow, which is the disciplined format and process that really operationalizes all of it and can turn it into a finished day return. So if the first 2 days were the what and why, today is squarely the how. And you do not need to be here for the first two. I will re-anchor everything you need as we go. But here's a single idea that the entire workflow rests on, carried straight over from day one. So crypto is property. It's your job to compute a gain or loss in every disposable and then report any income on top of it. So that's it. And everything we do is just going to be a careful, repeatable way to do exactly that, really at scale across your entire practice, even with those messy clients. So 3 concrete goals coming up. And they are really the 3 things a real crypto engagement actually demands from you in order. First, and in my opinion, the most important by far, is you're going to be able to scope a crypto engagement. So before you touch a single transaction, you'll actually know how to size the job, determine the complexity of the client, determine how many data sources, how many years they've been doing this, critically, how much staking and DeFi is in the mix, and then all of that to really appropriately set expectations up front with the client and price it accordingly so you're not accidentally signing yourself up for $1,000-hour project at $1,000 fee. So I'm going to say this a few times today because I've seen it. Scoping is where crypto engagements are really won or lost long before you even touch a single number. Secondly, you're going to be able to run the full workflow end to end. So the 5 stages in order every single time. And I'll walk through each one in more detail. And then we'll go through an example client and run her through the entire pipeline in front of you. So it's not theory, it's more applicable. The third thing we're going to be able to do is produce a defensible deliverable. And not just a number typed on a return, but a documented, reconciled package that holds up under any scrutiny, whether that be 2 years later on an audit or anything of that nature. So that's going to contain the reconciled 8949 gain and loss report, the explanation of the basis method you choose, all the sources, all the work papers behind your judgment calls. So when you can produce that, you really have nothing to worry about once you submit the return. So let's start with the whole map before we zoom in on any piece. If you hold the shape of the process in your head, none of the individual steps are actually hard, and no two engagements are all that different at the end of the day. So here's going to be the engagement on one side. So this is the 5-stage pipeline. And as I mentioned, every single crypto engagement you ever run is going to follow this order. Um, so stage 1 is going to be the scope. It's the size of the job before you start. It's going to be that first client call where you really have to be careful and push the client here, because even though you're trying to win their business, you need to nudge them to get a proper scope, because I mean, you need to determine how many wallets, exchanges, chains, total amount of transactions, how long they've been doing this, so how many years of activity you're going to need to reconcile, nature of the transactions, so how much DeFi, NFT, staking, all of it, because it's the stage that actually tells you what you are signing up for from the practitioner side, not just trying to recruit the client. Stage 2 is going to be that gather, and it's the data collection. So you pull every transaction from every source, so all the exchanges, the wallets, the blockchains. This is really the step that practitioners tend to rush, and it's one of the sneaky things that could kind of turn an engagement from smooth sailing to an absolute nightmare, and something you also lose profit on because you blow up budget. Third is going to be classification. And this is when we go through, take a look at the data, and label what each transaction actually is. So will it be classified as a buy, sale, swap, spend, transfer, or any income event like staking? The label is what determines that tax treatment. So this is where the accuracy part is determined. 4 is going to be the fun part, most technical part, and that's the reconciliation. Think of it like a tie out, except you're referencing basis track per wallet. Make sure the transfers match so nothing looks like a phantom sale. Any gaps you see are flagged, and you chase your client down for that data. So it's essentially tracing the whole picture, cross-checking it against the 1099 DA, and doing that puzzle using your professional judgment to really earn that fee, optimize tax for your client while also remaining compliant. Now, that 5th stage is going to be the report, which is where we just put the finished numbers where they belong. So disposals, 8949, that'll flow up to the Schedule D. Income on that Schedule 1 or Schedule C. And then you hand the client a defensible package. You guys both can stand it behind. So once you scope, gather, classify, reconcile, report, those are the 5 words you just need to go in with every engagement. And the reason that order matters so much is because each stage depends on the one before it. Can't classify data you haven't gathered, cannot properly reconcile classifications you have not made, and you cannot report numbers you haven't reconciled. So do not do them out of order. Don't skip one. Make sure the first 2 are done thoroughly, because it really just sets the stage for the entire engagement. So stage 1 is the step almost everybody, not almost everybody, but what's very common to rush, the just get started phase. And it's the one that from the practitioner side actually protects you the most, both financially and professionally. So before you gather a single transaction, you scope the job. And let me show you how to do that in an example. So all scoping is really just answering one honest question up front. How hard is this job going to be? And with crypto, there's stuff that makes it uniquely dangerous to price because in the crypto accounting sphere, there is huge variance. Because one client could have 100 transactions on a single centralized exchange. That could take you no more than an hour. The next client might come in and say, hey, yeah, I've got some crypto, say it very nonchalantly. And it turns out to be 40,000 transactions across 15 wallets, 5 chains, bunch of leverage DeFi, and 3 years of never filing. I've personally seen up to 10 because they have to back reconcile it because the enforcement started this year. So same 2 words on the intake form, but wildly different engagements. So a professional tip would be to never give a quote before you actually understand the complexity. So the checklist I ran on every intake would be 1, how many sources, aka name every wallet, every exchange, every blockchain you've ever traded on, because 2 sources might be an afternoon, 12 to 20 might be a project, and some of these guys have up to 100. And then 2, roughly how many transactions. And the nuance here is the client usually likes to answer that annually. Say, hey, I've done 300 this year. What they don't tell you is they've been trading for 10 years, and in 2021, they decided to hop on a bot trader, and they have 130K transactions that year. I've seen that happen firsthand, and obviously it requires a rescope. And if we're not setting the expectations up front, it's a lot of friction from the beginning. The third is going to be what kinds of activity. A simple buy and hold or simple buy, hold, sell. Pretty simple. But the complexity adds every layer you add, which is that staking, the airdrops, liquidity pooling, NFTs. Some guys play these games and have things called ordinals. So it just adds classification complexity, and accordingly is going to add hours. And then the fourth thing is just how many years have they been in it? I've had it where they say, hey, I've been in it since 2023. Get in it. They're like, oh, wait, I actually bought my first Bitcoin in 2017. Those years all stack on top of each other. So really the first question to ask is, when was the date of your first crypto transaction? So why does this 10 minutes matter so much? It's 2 reasons, and they're actually protecting you. First would be pricing, because if you quote a flat fee before you understand the complexity, you will lose money on the messy ones. And in crypto, you'll often find that the messy ones are actually the norm, not the exception. So do the scope first and then price the actual work. Make sure you get the written engagement letter that defines what's included, what's excluded, and what happens to the fee if the scope grows once you're in the data, because it's very common that it does. Second would be that expectation setting. So the client needs to hear from you upfront that this is a real process, and that you will need complete data from them on every single source. And that the client that's just like, hey, I only have one Coinbase account, is almost never the entire truth. So a solid 10 to 30 minutes of scoping could pay itself tenfold. And I really encourage you to be discerning on this part. So here's stage 2, and this is the gather. Now that you have scoped the size and shape of the job, you go in and get the data, and I mean all of it. So this is the stage that really deciphers an easy client from a hard client, no matter how hard the work is afterwards, because every number you produce later is going to be only as complete as what your client provides you. So let's be very precise on what the term all of it actually means. So here's the governing rule of the gather stage. And it's the same puzzle idea that I've run through on the past 2 sessions. And that really is just no single source sees the whole picture. So in practice, your client's Coinbase account knows exactly what happened on Coinbase, but they're completely blind to everything else they ever did. So the MetaMask wallet knows its own on-chain history, but it doesn't know anything about Kraken. So your job at this stage is to assemble the complete history from every place the client has ever touched in crypto. Because if you miss one wallet and every downstream number from there, every gain, every basis, it can be quietly wrong. So what are those sources concretely? There's centralized exchanges. In America, you're going to see Coinbase, Kraken, Gemini, Crypto.com, handful of others. And you're going to be pulling that through an API connection or a CSV export. And then you're going to see the self-custody wallets, which is like a MetaMask, a Ledger, a Trezor, or any other hardware wallet, which are going to pull by their XPub, aka public address on each chain that they used. And the other nuance is you have to think in terms of every blockchain separately, because the very same person could have activity on Ethereum, Solana, Bitcoin, and a half a other dozen blockchains. So each of which has to be pulled on its own. So my strong preference for exchanges is the read-only API key, because it streams the full transaction history automatically. And it also being read-only, you literally don't have access to the client's funds. So it's safe to hand over. It just helps the client trust. Scamming is very common in crypto, so clients can be skeptical. But when an API isn't available for a certain exchange, you could complete CSV export will work. You just need to be careful and make sure that it is the full history and not just the last tax year. Now, this part that will genuinely make the huge influence is going to be the missing source problem. It's not out of malice from the client. They just forget. Some of these guys have been trading 10 plus years. They forget an old wallet that they used in 2021 and sent 3 coins to, or did 3 transactions on, or the exchange that went bankrupt and it took their login information with it. One of the famous ones is Celsius, that created a huge tax issue this past year. Or the chain they bridged to for exactly a single airdrop. It's everywhere. And it's not dishonesty. It's just that people don't remember their entire crypto history because they never had to. So a good workflow, and this is where the software truly earns its place, will actually flag these gaps for you, because it'll take a look at the client data that they uploaded. It'll see a deposit with no matching withdrawal, a transfer coming from a wallet address that hasn't been uploaded, or a balance that doesn't add up. And every one of these flags is gold, because each is pointing you in the direction to kind of fill in the negative space of that puzzle and get the complete data set. So set the expectation with the client early and honestly. Let them know that it's only as good, that this quote is only as good as the data you provide me. And we almost certainly will not get it all in the first pass, and that's okay. So budget accordingly for that back and forth. You're going to pull what they give you. System's going to flag what is missing. You're going to go back and ask. They're going to have to take the time to find their old ledger that's sitting in the drawer. That loop is part of the job. It's very normal. Because here's the whole stage that this exists to prevent, and it's filing off that incomplete picture. And it's the single most common serious error in the entire practice. A preparer, especially an inexperienced crypto preparer, will just file off of one exchange's neat little CSV and then unknowingly leave off half the client's activity, especially if it's DeFi and they're not required to report that 1099 DA as we discussed yesterday. Final thing on this slide, everything we just discussed is exactly why it's dangerous to take on a crypto engagement on April 14th, because that gather stage needs the back and forth time, probably 90% of the time. Stage 3, you've now got a giant pile of raw data assembled from all the sources. Obviously, that raw data is not a tax return, so you have to tell the system what each transaction actually is, because the label is what determines the tax treatment. And this is the stage where most real errors are quietly born. It's kind of like the seed that's going to turn into a tree later. So let's take a little time and walk through and get this one right. So every transaction you gathered is going to fall into a handful of buckets. And simply the whole game at this stage is just putting together each one in the correct bucket. Um, so the buckets are here. These are very simplified, but they're the principles. There's the acquisitions, which think of a purchase with dollars, and which simply establishes basis and is not taxable. Buying something. Disposals, obviously the sales. The ones to watch out for are those swaps, which do not turn into dollars, and spends. Think a crypto debit card through MetaMask. So each one is a taxable event that requires you to compute a gain or loss. Next one is going to be income. Those are those staking rewards, the airdrops, the mining. Another sneaky one is being paid a salary in crypto or 1099 income in crypto, which is ordinary income at the fair market value the day it's received, or when you have dominion and control. So even if it's an option and the employee did not claim it, but it was available to be claimed and had a determinable fair value, that also counts as income. And then the final sneaky one is just going to be the transfers between the client's own wallets, which are not taxable events. They're not disposals. It's simply just the client moving their own property from one pocket to another. Now, here's why the classification is where the errors live and why it's almost always the last bucket. Because internal transfers are the single most dangerous thing to mislabel. Because if you picture it, your client's going to move Ethereum from the Coinbase account to their own MetaMask wallet. And if that gets labeled as a sale, which is exactly what a naive import could do, because Coinbase's isolated view, the coin simply left. So you have just invented a taxable disposal that never actually happened. And your client's going to overpay on that sale, air quote sale, that was really them just shuffling their own money. And then if you miss it the other way, the coin's going to arrive in MetaMask with no basis attached. So the single most important classification in the entire workflow is correctly matching those transfers, tying the withdrawal out of one wallet to the deposit in the other, so the system treats it as an internal movement, and that original cost basis rides along with the coin. So get those transfers right, and most of the return is going to fall into place behind it. The danger here on not tracking the basis is not necessarily compliance even. It's just that the IRS is going to look at it and say, hey, that has no basis on it. You're paying a full capital gain on the future sale. So it's a tax optimization process and a data completeness process. Now, the income events are the second place to be a bit careful on. As mentioned, it's those staking rewards, the airdrops, any proceeds from mining, crypto you're paid for work. Every one of those has to be tagged as income, valued at the day it was received or available. And remember that two-part rule we touched on in day one, because the received value is taxable income now, but it also simultaneously becomes your cost basis for when those coins are eventually sold. So if you mislabel an income event, say you let a staking reward import as a transfer, you've made two errors at once, because you've dropped taxable income off the return, that's schedule one, and you've also left that basis at zero, so the eventual sale gets overtaxed too. So one wrong label created two problems there in opposite directions. So let's make this all real by running one client through this pipeline from start to finish, because watching it beats hearing it out, of course. So let's meet our ordinary crypto client who we actually met on Wednesday. Her name is Dana. Nothing exotic about Dana. This is a very simple case, but she's exactly what's going to walk into your office. So the scoping stage. On the intake call, Dana says the famous last words, yeah, I have some crypto on Coinbase. You run through this checklist, and it turns out she actually has a Coinbase account, a Kraken account, a self-custody MetaMask wallet, a Phantom wallet, you name it. That's three sources already, not the one that she mentioned. So all of a sudden, a few hundred transactions, some staking rewards, a single DeFi swap in a single tax year. You price it accordingly to that and get an engagement letter signed. So 10 minutes, and you already know it's not the trivial job she implied off the first question or the intake form. Next is going to be the gather stage. So you're going to connect Coinbase and Kraken with those read-only API keys. You're going to pull the MetaMask by its XPub, and immediately the workflow flags something. A transfer to Kraken from an Ethereum address you have not loaded. Now that's the tell that there's a missing source. That's when you need to go back to Dana and said, hey, is this your wallet? Did you ever use another wallet? Again, 90% of the time, there's some hardware wallet she forgot about or another DeFi wallet that she has to go find. So you load it in, and now that picture becomes complete. So that one flag you chase down just saved the entire return from being wrong or saved you from having to zero out a bunch of cost basis, which is going to cost her money. Now on to classifying. Most of Dana's activity is straightforward buys and sells, but 3 transactions stick out and need a careful human hand. And that's really the whole ballgame as practitioner. First one, she moved Ethereum from Coinbase to MetaMask. It's an internal transfer, not a sale. So you have to manually match the withdrawal to the deposit so the basis of the coin flows through. 2, she earned staking rewards on Kraken. That gets tagged as income at their value on the day received, which also sets their future basis. 3, she did a swap from Ethereum for another token inside of MetaMask. That is a disposal. It's fully taxable on sale, even though you did not see any fiat currency enter the picture. So the same client, 3 transactions, and 3 completely different tax treatments here. Now you got to make it tie out with the reconciliation. And basis is tracked per wallet. So Coinbase, Kraken, MetaMask, and that ledger each stand on their own. So you decide as the practitioner, you apply one consistent cost basis method. You lay Dana's 1099s from or 1099 DAs from Coinbase and Kraken next to your reconciled data, and then resolve the differences. The blank basis you're now supplying from her records, the transfer from the broker's form that they counted as a sale, and you chase every remaining flag to 0 until no balance goes negative and nothing is unexplained. Finally, the report. So every one of Dana's disposals, the sells and the Ethereum to token swap goes on her form 8949, which then summarizes, flows through to that Schedule D. Now her staking reward income goes on the Schedule 1, and the digital asset question at the top of that 1040 gets an honest yes. So that's the whole pipeline on one real client. The scope caught that it was a bigger engagement than what she said. The gather caught that forget and ledger wallet. You classify the sorted 3 transactions, treated 3 different ways. You reconcile to make it defensible. And then that reporting package put every number in its place. So again, this is a simple example. Some of this gets crazy, but if you run the same 5-stage process on every client, it will work. So yeah, not every transaction is the same. And yeah, really the big nuance here is the engagement time, the complexity, the date of the first trade, and that data completeness. Because the other thing practitioners miss, or at least clients miss, is that the IRS is looking for both data completeness and data accuracy. So even if you appropriately aggregated the balance and are paying the right amount of tax, if they don't see it all tied out to the 8949, you're out of compliance. Stage 4 is the reconciliation. So we're going to go a little bit deeper on this because I ran through it rather quickly in the example. And this is really where your professional judgment does that heavy lifting. Because once everything's gathered and classified, reconciliation is where you turn it into numbers. You put your signature and license number behind. So reconciliation and tie out. Reconciliation in its most simplest form is 4 moving parts. And I want to walk through each one. because this is what really makes the return defensible. The first one is going to be that basis tracked wallet by wallet. And if you could recall the rule from earlier this week, as of January 1st, 2025, you're now tracking cost basis per wallet rather than being pooled across their entire portfolio, which was formerly known as the universal method. And technically, that is under Revenue Procedure 2428, aka RevProc 2428. But that's a little too in the weeds here. So each account and wallet stands on its own for basis. And when the coins move between them, the basis has to travel with those coins. So your reconciliation has to honor that per wallet structure, or every gain calculated downstream may be suspect and out of compliance. Second is going to be that cost basis method or inventory method applied consistently. So let's say you choose FIFO or specific identification. Once you choose it, you apply that same method consistently throughout, because flip-flopping year to year invites scrutiny and not something you want to do. And the timely, citable point for anyone in this room who files, for identifying specific tax lots, aka practicing spec ID, there is transition relief from the IRS. There were two notices. They were called 2025-7 and 2026-20. And that lets your client make that identification in their own books and records rather than having to instruct the broker in advance. So in a practical sense, that means your work papers are the identification right now. And that's a real tool you could use deliberately, because in the future, the trader is expected to notify the broker in advance the details of that transaction. I don't think it makes a ton of sense, but it's what's coming down the pipeline for now. Thirdly is going to be the reconciliation against that 1099 DA. And this is the entire second day of this week, really compressed into one step of the workflow. So you lay the broker forms next to your reconciled data and you resolve every single difference. So the blank basis you're now supplying, the transfer the broker miscounted as a disposal, the acquisition dates that are off, the proceeds on the figure that doesn't match. So again, the principle one more time is that your client's complete records are the source of truth. So the 1099 is what the IRS is holding, but your job as a practitioner or taxpayer is to make the return agree with that form, and where it legitimately differs, just have clear documentation as to why, because the 8949 is going to be more accurate than the 1099 DA, even though those centralized exchanges are providing that form to the IRS directly. Fourth is just to chase the flags to zero. So a good workflow doesn't just process the data, it actively snuffs out the problems, which are always going to be the missing basis, unmatched transfers, and my personal favorite diagnostic, which is a negative balance. So if your recon says that the client sold 3 Bitcoin, but you can only account for them ever acquiring 2, that impossible negative balance in the system is screaming that a data source is still missing. So never paper over it, just work through each flag until it clears. When the flags are all cleared, the basis is per wallet and consistent. Your data ties to the broker forms. Now you have numbers you can sign your name to. So that's what the reconciliation buys you. It's not just an answer, but it's confidence in your answer and confidence in the product you're actually selling to the client. Last but not least is the report. We're at the finish line here. So clean reconciled numbers become a filed return and a finished engagement. So on the next slide, we're going to walk that through in a little bit more detail, but from a high level, it's just a defensible deliverable, that what it looks like when you hand it over to the client. So where every number lands. What you're looking at the screen here is a map of the return. And there are 3 destinations, and everything you reconciled previously flows to exactly one of them. So disposals go on that form 8949. That's going to contain every sale, every swap, every spend, reported line by line determining or giving them the information, what you acquired it for, what you sold it for, the acquisition and disposal dates, and the resulting gain or loss from that. So think of it like an itemized receipt. Um, this is the detailed information. And at any real volume, it's precisely why these crypto tax softwares exist, because hand keying 4,000 lines on an 8949 without losing your mind sounds brutal. So that's that 8949. That total will then flow up onto the Schedule D. You guys are all familiar with that. It's the summary sheet where your short-term gains and losses and your long-term gains and losses get netted together, short versus short, long versus long, and then against one another. So this will go into the final capital gain or loss number that will eventually flow through to the 1040. So this is for all capital assets, can include the stocks that the client's trading and play the whole capital optimization game. So the chain on the capital side is clean and worth memorizing. Disposals land on 8949. 8949 rolls up to the Schedule D, detail sheet, then summary. Now, income takes a bit of a separate path here. So let's not let it blur. The staking rewards, airdrops, crypto they're paid in, that ordinary income is going to hit the Schedule 1. And that's going to be classified as other income, or Schedule C if the activity raises to the level of a trade or business. In that instance, think like mining operation or someone professionally trading as an occupation. That's a different bucket from capital gains. It's taxed differently. And one of the more common mistakes I've seen is earned crypto getting swept into that Form 8949 or just dropped entirely. So the whole reporting stage is really just disciplined routing, disposals on 8949 up to the Schedule D, earned income Schedule 1. And of course, the digital asset question at the very top of the 1040 gets an honest yes answer from the client. Because obviously, after doing this reconciliation, it's unambiguously a yes. One thing I do want to raise too, having worked with these clients, there is an ethos in the American crypto community. A lot of these people don't believe DeFi activity is taxable. So really make sure that you are approaching this through a skeptical lens and making sure that they're giving you everything. During the recon, it will become glaringly obvious that they didn't. But understand you're battling some stigma here where clients are not yet educated that everything's taxable. So sometimes they just want to provide the centralized exchange data because they're KYC'd and that's all the taxpayer will know. All right. The distinction that matters enormously. Filing the numbers is not the same as an actual finished engagement. So what you actually hand the client, and just as importantly, what you keep for your own record keeping is a defensible package. And yeah, this is the single difference between a professional and a consumer. You're going to have real standard defensible work. And let me walk you through what's in that package. So the obvious one, you're going to have that reconciled 8949, the full capital gains report, the complete details standing behind every single figure on that return. Two, you're going to have the cost basis method documented in plain language. So whether you use FIFO or Spec ID, it's clearly stated. So there's a permanent record on the methodology you applied. Third thing is going to be that source list. So every exchange, every wallet, every chain you pulled from, so that it's really self-evident that the picture was complete and nothing was left out. Again, that's touching on the completeness assertion, just as important as accuracy. Fourth thing is going to be the notes on that reconciliation. So specifically how you resolved each difference against the 1099 DA and the reasoning behind it. Fifth, the work papers. So behind any judgment call you made, whether you reconstructed basis for an old wallet, any unusual DeFi activity, anything you'd really want to be able to explain cleanly if asked a year or two from now. Now, here's why it's worth the extra effort here. beyond just good professional hygiene. So we covered what letters are going out yesterday. Those 6174 and then eventually CP2000s. That's just from an automated mismatch letter that the IRS computer generates when a return doesn't line up to the actual 1099 DA. So if one ever lands in your client's mailbox, the package is going to be a response. It's going to be sitting in a folder. You're not have to go do this reconstruction 2 years later when you're under a deadline and you don't really remember this client. So if you have this package, it's just going to give you peace of mind, save you time in the future if this ever happens, and it's going to explain everything line by line. So in crypto, where the data is messy, these forms are new, the scrutiny is rising, and quite frankly, the system isn't fully operational yet. That documented confidence is the value you're going to provide, and it's really what the client is paying for. Two things that live outside the 5 stages, but make you as a practitioner dramatically more valuable is something I want to flag on this slide. And it's first, it's the timing. So the entire workflow gets easier the earlier you begin it. A client who comes to you in February with organized data is clean, it's profitable engagement. That exact same client showing up on April 14th with a shoebox and it's just a nightmare for both of you. Because as we saw at the gather stage, you need time for that back and forth of finding those missing sources. So the message drill into every crypto client is simple. It's a year-round discipline, not an April event. Have them build the paper trail as you go, keep the records as you go. It's the single best thing they could do to shrink on their end, their bill, on your end, your workload. Second's going to be planning. And here's the real payoff of doing this well. Once you see a client's complete picture, you could actually turn into an advisor role, not just reporting role. So if they had a huge realized gain for the year, they very well likely do need to be making quarterly estimated tax payments so that they're not ambushed by a huge bill filing. If they're sitting on unrealized losses, you as a practitioner are going to know that the wash sale doesn't apply to property yet. So there's generally room for tax loss harvesting, settling to bank a loss, and stepping right back in. Same day. If you see a distressed asset, sell, buy back in. I just did it with the most recent Bitcoin crash. So always do it with a sensible eye on the economic substance of course, but you as a practitioner have a lot of flexibility here. You could save your client money by waiting across into long-term rates. You could do it all. So you just go to the planning phase, you become more of a professional, drive more value to the client. So you're not just being a reconciliation data entry person. All right. This slide is designed to just save you pain as a practitioner because it's just the 5 most common points where workflow breaks. One is starting too late. We have, hammered that home. I don't need to go on about it. 2 is the one source picture. So filing off of a single exchange's 1099 or CSV and not really understanding how the crypto ecosystem works. So if you have a traditional practitioner, the client brings them a 1099 DA form from Coinbase. They think, wow, super reputable company. Cool. The numbers are here. Hey, this is how Charles Schwab's work. Let me just file it. And they don't know everything under the hood. So that's a big one. And it's key to the education layer of the accounting community. Third thing is going to be mislabeled transfers. So the internal wallet to wallet movements get treated as sales, inventing taxable events, and overcharging your client. And that's classification failure. Fourth thing is going to be that inconsistent basis. So not tracking on the per wallet as the rules now require, or flip-flopping your method from year to year without an explanation. That's simply a reconciliation failure that will invite scrutiny. The fifth, of course, is no documentation. The numbers might even be right, but if there's nothing standing behind them, you're going to get, if a notice arrives, you're going to have to rebuild the whole thing from scratch. So that's really that reporting stage failure. it's very important to just be meticulous and do the hard thing up front so that in a few years you can just hand them over a package. And I just want you to notice the pattern here. Every single failure maps back cleanly to one of the 5 stages, which means every single one is caught simply by running that stage properly. The encouraging thing, though, about all this is there's very little bad luck in crypto tax. There's just mostly the process you did or did not follow. So run the 5 stages in order every time. And yeah, just make it so not one of those 5 failures could sneak up to you, and you'll have a thriving practice in this regard on the crypto side. So we're almost there. We're at the finish line here. So if this entire week, the 3 sessions compresses down to 1 hour, and that hour compresses down to 5 lines, make it these. First is just run that pipeline in order. So the scoping, the gathering, the classification, the reconciliation, and the report generation. 2 would be that gather stage. Understand that no single source ever sees the full picture. None of these companies are under the same entity. They don't talk to each other yet. So when there's transferring and a bunch of intermixing, it's an incomplete picture. Third is going to be to classify those transfers correctly, or you're going to invent a taxable event that is not owed. Fourth is going to be to track the basis per wallet and reconcile the data against the 1099 DAs. And then that 5th and final thing we just hammered in is just deliver a documented defensible package to your client, not just a report on the return. So to get those 5 right, I promise, no matter how complex it is, the weird edge cases, that'll come through when you're doing your work. But once you follow the 5 principles, you're really not going to have trouble. The rest is just nuance. So that's really the entire week distilled, and now you have it in your head. So I want to thank you all for spending 3 sessions with me. It's been an absolute pleasure. Crypto tax can be a little sticky, so I hope simplifying it down was helpful. And I do want to extend. My name is James Knape. I'm active on LinkedIn, so if you ever want to connect or have any questions, feel free to reach out to me there. Otherwise, my email is on the screen, jamesknape@summ.com. I read and answer both. So after a full week like this one, would love to hear from you guys. So thank you. Thank you all for your time today, and I hope to hear from you soon.
Thank you so much, James. Have a good weekend.
You too.